right, things settled down a little bit. We got a quick short-term bounce. It was so quick, it only lasted a few hours, but it did settle some things down. We didn't get such a big range as we did the last couple of days. Volume was still pretty high. We didn't go very much to. We went to new lows, but not significantly lower lows. So are we in the process of bottoming now? And it's going to be a process that will most likely now take a couple of months. At least a month to 2 months. So I'll talk about why and what patterns I'm seeing and how that might look like. But in the midst of that process of bottoming, there's going to be some ups and there's going to be some downs, and the more that we get those ups overnight trading, that's not necessarily a good sign. And I'll show that too. So if we end up with some more downs tonight in the overnight, that actually might be a really good thing for us to come up and really bounce off these short-term levels. So that's kind of, I'm going to break that down in today's video. We're also going to take a look at a trade that's poised. If we do have some volatility here in the next couple of months, that can really has some downside potential. We're going to talk about how to trade that in this volatile period. So let's go ahead and get started. Today is Wednesday, February the 26th, 2020. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast indicator on the S&P 500. You can see the long upper shadow, long shadows after a move up or down can be, in this case, bullish. But long upper shadows not nearly as bullish as long lower shadows. Again, it's where the market closes that matters a lot more than where it opens. So, and long upper shadow means obviously that we close at the end of the low at the low of the day. Instead of closing close to the high of the day, which is what a long lower shadow. So that's why those are more bullish. But these are still bullish nonetheless, just obviously a lot more weakly bullish. So keep in mind that, the bulls were in there. The bulls had a run today. They could very well continue to maintain a run. If you take a look, short-term sentiment's very oversold, continues to be extremely oversold. So we're not going to be bouncing up here anytime, like in terms of like a V-bottom recovery anytime soon. Again, dark pink shading and red line, and we've got that now on the Dow, on the S&P, on the Nasdaq Composite, and of course on the Russell 2000. Where on the Russell we are breaking below the 62% retracement level here of this move. You can see. That's a pretty significant decline, obviously, going all the way through there. And again, in terms of like a long-term reversal, you look for that when you break the 78%. Considering this is the long-term trend to the upside, higher highs, you would look for now a long-term trend to the downside if you were to break that 78% level. So we're not quite there. We're obviously just barely touching on the Nasdaq. We're barely touching the 38% level. So not nearly the same level of declines. Then you look at the Dow Jones Industrial Average, and it's already actually a little bit below the 62. And if I were to add on the 78% there, you can kind of get an idea of how far it would need to fall below, right, for us to be able to consider that a move back up now would be to a lower high point and we'd trend to the downside. But we're not there yet. And again, you see the long upper shadows, and they're bullish patterns. They're just not strongly bullish, mind you. And again, I wouldn't necessarily be looking to buy this dip for a new run like this anytime soon, right? We've seen, I've shown you other periods of time where the expectations were for market sentiment declines. That's a market sentiment decline. That's a market, and this is the low point that we got like right immediately, right there. And there's a low point that we got immediately right there. So those were not good times to buy, right? And that's what this would be here if we get a similar move. And I don't think we're having this type of move like we had in early August. We have bigger declines. In fact, the last time we had this significant of a decline, we have to go all the way back over here. Was it August? August of 2015, right here. And that did set the low point. We did come up and down for a little bit of time, but we were already that was like at the end of a market sentiment. We had already been on a intermediate pullback market. We had been dropping for a while here, and we finally dropped there, and then bounced off of that. So we're just starting. And I expect, and again, Here's the big difference between a market sentiment pullback where the orange line drops below 50 and an intermediate pullback where only the green line drops below 50. And that is, you can see the length of time. I was asked a question, I believe on YouTube, what's the significance of the market sentiment pullback? And the significance is that, a length of time. Is it going to be a multi-month pullback with multiple ups and downs involved before we finally get going to the upside? With dark green shading, and I mean, we're not going to get a green line anytime soon, right? Because we got to get above a rising moving average, and you can see we're so far below, we're not going to get that anytime soon. So that's what a market, the intermediate pullback, it's not the case, right? It's more of like a few weeks of ups and downs versus a market sentiment where it's a few months, and that's kind of now what I'm expecting here with the decline that we're getting in the S&P 500. And I've shown you this chart before, but let me bring this back to a daily chart and then bring this to a how far below the 30-day moving average we are on the S&P 500. We had gotten down below 5%. We're still below 5% here. All right, so we're still extremely far away. So very good likelihood that we get bounce back up, especially considering that we're trading around that 200-day moving average. I did mention the fact that we could go below to that 62%. We've seen that before in some of these other instances. Here, let me zoom out a couple years. So you can see, we can flirt with going below the 200-day moving average before coming back up above it. And that would require a drop to the 30-40 area, 30-50. And that's very much within the realm of possibility. Might not be tomorrow. And if it does, it might happen overnight. And if it happens overnight, that'd be great, right? We want the big extreme moves to occur in overnight trading where the volume is extremely light, so we can get the bounces to occur in the regular trading session, which are more significant than the bounces like we saw the last couple of days that occur overnight. We don't want bounces overnight after these big sell-offs. We want more selling overnight in very light volume, and then to come out of that, right? That would be the more ideal. So we'll see, but it'd be ideal if we got down to 30-50. More than likely, we're probably going to, it's probably going to be a little bit of time. In fact, I kind of think we'll probably diverge with a bullish low into that level. So it might bounce up and then roll over and then make it down the lower lows and really send the world into a freak show and then hit that for support, because there's a lot of support here with volume, lots of volume in this area. So there's a good opportunity that will bounce off of these levels. At the worst case scenario, a good opportunity to bounce off, I believe, the 78% Fibonacci retracement, which would be down in this area, 29.58. I mean, again, they kind of show you how much volume support there is in that area. That's where the biggest volume node outside of the point of control is just right above that level. So it's going to be, we can definitely come down here, and we can definitely work our way a little bit lower down towards 300, but it's going to be hard to get below 300. And that won't be impossible because nothing ever is, but it will be really hard to get below 300. And I can see us, like I say, diverging a low point into this 305 to 300 area before bouncing and making our way back up by summertime. Remember, we usually peak. There's that May 1st seasonal peak, but there's also, after that, the actual year, the peak of the year from a seasonal trending standpoint, when you look at the seasonal highs, and look at this is kind of interesting too. So we were kind of tracking along at the beginning of the year, as crazy as we thought we were, as bullish as we were kind of tracking along with the 5-year. Of course, with the 20-year, it's a little bit of a different story. We were really far above it, and we pulled back. But you can see it's really that July expiration is where we peak on the year, and we kind of retest it again at September's expiration before we get that weakness. But that's really, there's a period of weakness in June, post-June expiration, but then we generally rally in early July all the way up to July expiration. That's where the mid-year peak is before we get this bout of volatility before the year-end run. So we'll see. We're got some weakness. This is typically a volatile period of time, as we see from a seasonal standpoint. I don't think that we'll now jump straight up and head up toward these June, July highs. I think it's going to be a month or two of figuring out these lows before we start making our way back up again. to the upside. Now, this looks a lot more significant than it is, right? This is a 4% rise versus a 1%. This is a 4% drop year to date versus, 1%. So, as drastic as that looks, keep in mind the scale, right? When you look at the scale, it's not nearly as, if I shrink the scale up, obviously it's not nearly as drastic. I mean, there's your 20% returns. This obviously we don't have 20% average returns on the S&P over the last 20 years, right? Now, if you look at, last 10 years, there's now we're looking at a 10% move. And again, they kind of show you that's, again, that's actually here in the last 10 years, it's been kind of late July where we've had the seasonal peak. So we've got some opportunity for a month or two to figure out a low point and still be on pace to get back up to that July high. And I think that's perfectly within the realm of possibility. The more people go crazy, the more likely that scenario is, right? Because the market's not very good at pricing in recessions, and considering how overbought the safety trade is, and considering they're trying to price in recessions, they're usually not correct in pricing that in, as we saw last year, and we'll probably end up seeing again this year. All right, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below our video if you're watching us on YouTube. Also, that will notify you when these videos are posted. Also, hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today, and it tells us that you want us to do it again tomorrow. So it's a quick way to give us feedback, and you want us to keep doing these. If you don't like our videos, then you don't have to click on anything down there. It's a quick way. We always look to see how many thumbs up we have compared to how many views we have to kind of get an idea of what people think about us, about whether we should keep doing these. Again, you can also join our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click on that link. Takes you to a page where you can subscribe to our site for free. Follow us on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. All right, also, if you're watching us here on our website, you can see there's also a link right up here to subscribe to our site. Click on that subscribe button, right, this blue button at the top. We also have our Market Outlook live videos where I go over past trades that we've done in these videos. So the difference between Market Outlook and other videos is a lot of people will tell you stocks to look at or to trade or to watch or to buy or whatever, but they don't actually tell you the trade. They don't manage the trade going forward from day to day. So we do that. We manage the trade ideas you get here as examples of what we teach. We manage them all the way to the close and talk about when to get out, how to get out, and we actually do close them in real time in these videos. And for those of you who are premium subscribers, if I close them out between, you get alerted on those. So with our trade alert service that we use. It's one of the most commonly things that we get asked for, and that's where that's at right there. You can also mouse over Market Outlook. Clicking on Market Outlook will get you the most recent one, but you can see there's the link that takes you to our live trade review videos as well, where all the archives of all the old live trade review videos are too. All right, so we take a look now at, again, the kind of more common period. You can see on the Hakinashi candle, where we had a relatively high PPO and we had 1 week where we came down and tested the 200-day moving average. This is the last two examples, and these are the last two examples of market sentiment runs. That's why I think this one will be a market sentiment rally too, not just an intermediate pullback like we saw on these pullbacks here and this one here where we dropped below that 50-day moving average. PPO is high, so we're not falling off a cliff here. There's still strong momentum. We're just obviously the selling, and how strong the selling is because we're losing such strong momentum. That's the problem with getting very strong momentum. That's great. When you buy down here, we were really bullish over here, and we've been getting, as the momentum is getting stronger, we've been getting progressively less bullish. I mean, you've probably been so annoyed with me and wondering, why does he keep talking about getting less bullish and the market keeps going up week after week after week? Well, here's why. Because of a week like this week. We don't know when it's going to happen, and it comes like a tornado, and it came this week. So we're seeing that here. You can see the Dow Jones. It's the Nasdaq's got a lot of room to flirt with that 200-day moving average, and then you can see the Russell 2000 is well below if you look at the regular Hakinashi candle here, it's actually well below its moving average. So we'll kind of keep an eye this next couple of days for a long lower shadow to form on these. Clarence Carr, one of our market scholars, pointed out on Twitter. I'll bring this up here since we are getting to the end of the month here in February. If you take a look at the February chart you can see a long upper shadow forming here. Let me get rid of these drawings really quick. You can see a long upper shadow developing on the monthly chart, which again, another sign that we might be bearish for a while. That's what, there's our February when we had that market sentiment pullback. There's a market sentiment pullback here. You can see we're extremely low on the momentum line. The near-term line's down below 50. So I don't think necessarily that we're going to be like rolling over. And you can see we don't even have light pink shading and yellow line. That's the last time when we were in December, that horrible Q4 produced a really enormously bullish pattern here. But you can see, we can also form something like this. Like every reversal starts with that. I mean, these are bear markets when you get dark pink shading and red lines. Otherwise, when you get yellow lines and light pink shading, they turn out to be really, really bullish patterns. And as of right now, as bearish as we are, we don't even have that yet. But I do expect we'll get, even like we had over here in January, where we were also pretty far up above the moving, in this case, the 30-month moving average. You can see we spent a couple of months hammering out the low of that candle. We don't have a long lower shadow this time, which is unfortunate. The long upper shadow is a lot more bearish. So there's a good opportunity that we might work our way back down towards that moving average. I mentioned before, 30.45 would be the kind of the level, and then that 29.50 is where there's some significant support. And probably by April, if we were there, that moving average will be around that area by then, if we spend the next couple of months working our way in that direction. Let's take a quick look at the 3 green arrows here for the S&P, and you can see 3 red arrows, not surprising. And I mentioned, we are still 5% below. Whoops, sorry. I need to go down to this one. I keep forgetting it got squished down here. We are 5% below the 30-day moving average, and we are way below the 8-day exponential moving average. It's catching up, but we're way below there too. To kind of give you an idea, of what that looks like here. We'll do the change this MACD down at the bottom. See, the MACD right now shows you the gap between the 8 and 17-day exponentials. Well, if we look at the gap between how far below we are below the 8-day moving average, there we go right there. Then if I were to zoom this out so you can see some perspective, we are about 15 points. This is not percent, this is points, so it's an absolute value, so keep that in mind. But again, you can kind of see that over here we were over 10 points, and the value, the market at the time was at 275. Over here we were also 12 points or so below the 8-day. So it just means that we're significantly below the 8-day. It's hard to pull away too much further. And the 8-day is falling fast. So again, don't be surprised if we don't bounce up really quickly back up to the 8-day moving average, like in this example here, where we're at a significant low point in August. Of course, back here you can see how we quickly bounced up to the 8-day after being so far below. That was October of 18. This was January of 18. Again, we bounced up quickly, came down again, and bounced up really quickly all the way back up to the 17 30-day moving averages. So in this next day or two, there could be a little bit more to the downside, to that 62% retracement. But as far below we are that 8-day moving average, don't be surprised if we don't bounce up really quickly. And it will sucker a lot of people thinking that we're done. Here we go, V-bottom. You'll hear people talking about it on TV, but the reality is it's just an extremely oversold, short-term, quick bounce that will find some resistance either at the 8 or 17, most likely. Not 100%, but most likely at the 8 or 17-day moving averages. All right, if you take a look at the intraday chart, of course, we are way down. You see, remember how I told you, I believe it was on Friday, I told you the danger of having the high tag and the 4-week low tag in the same side of the chart, on the right-hand side of the chart. I've shared with you this chart before. I think I have it here. The Arun chart. The Arun chart, when they both get up here, that's not the best sign, right? That's usually a sign that we are really getting bearish and we are headed towards a more significant pullback. And of course, we got that right, not here, but on this one. both lines over there, which, again, it's going to be a while, right? Like when this red line is here, let me zoom out to that 3 years. So you can go back to the last market sentiment pullbacks, right? So here's the market sentiment pullback, and you can see the red line again tells you where that low tag is. And within this is a 20-day Arun. So this is where the low tag is. The 100 is the far right, the 20th day, and 0 is the first day, right? So the more that we have, I mean, look, even over on this big long market sentiment run, we didn't spend a whole lot of time up here with the low tag in this area. It progressively started to move down. It hasn't yet, but it progressively started to move down. It usually only spends a couple of days on the right-hand side before moving down towards the left-hand side on all of these before we get a bullish run. So which means once it gets down to over here to 0, remember, it's on the far left-hand side of the 20-day, and the green line is the high tag. So during this market sentiment pullback, we had the low tag on the far left and the high tag on the far right. And then during this market sentiment pullback, the same thing briefly. Very, very briefly. You can see we had, a lot, the low tag spent a lot more time closer to the far right on both of these levels. So I expect that we'll probably end up getting something more like this, where it's more brief and then that low tag starts working its way to the left, and we have a brief little period of time where it looks pretty bullish and it kind of suckers you in before we get another retest. So that's kind of what I'm seeing on the intraday chart here. That low tag, there's not very much volume above us. That's why it goes up. That's why it can go up so quickly. In fact, let me see if I can do this. Yeah, it's not going to let me go back to that and keep it on the intraday chart back in that early February of 18 when we dropped really big. But again, the reason why we go up so quickly is because there's very little volume above us. We go down so quickly, there's very little volume. And if and when we do bounce, we know where your resistance is going to be. Like for the next 3 weeks, your high tags, we're not going to move that high tag anytime soon. It's going to work its way all the way down here. So again, think on that Arun indicator, the green line going from 100 when on this day when we were on February the 19th, the green line was at 100, and now it's working its way gradually towards 0 as it gets over here the 1 as it gets over here on the left hand side of the chart. And so now this is at 100, right? The low tag, the red line's at 100 because the low tag is right here. And so, but that again, it's rare for us to spend a lot of time there. We typically bounce and the low tag moves, and even just a little bit, the low tag moves, and more often than not, gradually moves towards here too, because we have so little volume to keep from. In other words, we don't set new lows in the 4 week a lot. We kind of boom, 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 and then we bounce and we move our way, and it might take a few days, right? But I mean, it's already the range today. If you look at today's range, last couple of days we've had 12-point ranges. Today we're at 7 points. So already our ranges are kind of slowing down. The volume still stayed really, really high, so it's going to bring those averages up. We're to that 1.5% mark, which is where we start looking for that. When we get up to 1.5%, we start looking for that market sentiment decline. Right, and just to kind of show you, that's where we got this time, and that's where we got over here too. They eventually got up there, and they didn't quite get up there. They got really close, but didn't quite get up there on these. So again, a few more days of being well above. 1% right now is 3 points. So the more 6, 7, 8 point ranges we have, they don't even have to be 12, but that's going to continue to bring this up towards 2%, right? And which is good, because you can see when it gets really high, then we come down. It's really, really quickly to go up, and it takes a long time to come down. That's why these moves, really, really quickly to go up, and then really quickly to go up again, and then it takes a long time for it to come back down. Very gradual bullish moves. Even over here when we got up, it took a long time for it to come back down. So here we go again, which means more than likely we'll have a period of time where we have a long period of time where they all come back down again, and that's typically bullish. So it just won't be this week. It won't be next week. We'll still, have some volatility here. And you look at the VIX, and another good sign that we're not going to go absolutely nuts is on all of those other periods of time. So I go back those 3 years. So those other times that we were a market sentiment pullback here, this one only got to 115%, and everything was actually looking fine. So we had that last leg where the Fed raised rates. But this was a lot worse. January, February is a lot worse. And like I said, it took multiple months. It might not take as long because we're not nearly as bearish this go around, and nor do we expect the Fed to make a policy mistake to exacerbate that one when we were well on our way to getting things working at the end of the year that year. So not nearly as bad, and we didn't really, as much as we were down today, we didn't go up above 30. And we're not going up to that 125% mark where things really kind of go nuts, where it's like, okay, it's gonna be a while before we work this cells out. It's not, I don't think we're headed towards death cross environment here, like we saw over here, and then eventually, again, if I go back a little bit further, you go back to that 15. This is the last time we hit that death cross environment. You can see we did close above 125%. So that kind of says we're going to be headed. And that was August of 15 when things went really nuts. If I go back to the long-term chart here, there's August of 15. You can see the PPO was already pretty low, and we headed into death cross environment. We're not heading into death cross environment here. It's at worst, it's going to look more like that point where it takes a couple of months. At best, it's going to look like what probably should have looked like here without that policy mistake, where we would have bounced in this area. But that extra, the trade war tweets and then the Fed rate hike really put a damper on things, and that's why we had that extra leg that we probably didn't need to have, and we would have rallied up higher here. So I'm venturing to guess it's going to be somewhere in between, in terms of length of time, these two pullbacks, minus that extra leg that we didn't have to have lower there. All right, so before we look at what's driving this price action, I'll only spend a few minutes on that because we just spent about 25 minutes on that technical outlook. But it gives you an idea of what I'm thinking and what I'm expecting now. And again, we'll be able to, we can trade this. There's ways that we will trade this in our classes, and that's what we'll do in directional options. And a lot of cash has been freed up. I've closed out some short puts and other trades. It's freed up a lot of my cash in our class account, and that's normal, right? So now we can use that and start making some trades and take advantage of this high volatility that we're getting, as we already have been this week with some trades that we've done this week. So it's okay, right? This type of move is okay, but you kind of get an idea of what I'm expecting and why and what I've seen in the past, and hopefully it helps calm the nerves a little bit, so that you don't get freaked out too much and don't do anything, get kind of paralyzed, because hopefully you weren't more bullish here in the last few weeks than you were in October. Hopefully you've been getting progressively less and less bullish. So as painful as today was, it could have been a lot worse. And I would hope for most of you who watch these and been paying attention to me, that's been the case. I hope it hasn't been the opposite, where you have been more bullish now, especially after that kind of false low point that made you think things were going back up again, and then got hammered in this week. That hasn't been what's been going on in our classes, and I hope that hasn't been the case with you. So what do you think about our outlook? Do you agree with that? Do you disagree? There's a link right there in the top right corner of your screen. Click that link. It opens up a poll. Hit either agree or disagree. If you click disagree, let me know down below. And let me know, if our education has helped you out in this past week with how you traded versus how you traded maybe in the past during this time or this time back, or excuse me, you don't see my charts, but back in October or back in January of 2018, as what we've taught you, because that back in January of 18 was before we started our classes. In October of 18, that was when we were right in the thick. We had just started. We've been going for about 6 months. So has this helped you? Has our education helped you, and how? Let us know in the comment section below so other people can kind of get an idea of what they can get out of our Market Scholars education too. All right, so now let's talk about what's driving this price action. And needless to say, I don't think we need to spend a whole lot of time on what's actually driving it, but other than the fact of what's going on, and the yield's falling down to 1.31%. I actually kind of expected it would go below here, and remember, I expected it would go to 1.25%, and we'd form a bullish divergence, and that's still the case. I still expect that. And as doom and gloom as things were back here, the last time we had a similar pattern when we were flirting, when we finally broke 2 and people were going nuts. So we were broken below 2. We got all the way to 1.5, formed that bullish divergence, and boom, we went from 1.5 to 3. We doubled from July of 2012 to December of 2013. We doubled in yields, and yes, there was some QE involved there, and that helped a lot. But that's the kind of move I actually expect again, which will be significantly bullish for risk appetite and equities. So again, it's not too common for recessions to start with extremely low yields. Extremely low yields are very stimulative. So it's going to be hard to be recessions start because we're too excessive in risk when yields are too high. And that obviously hasn't been the case here. If you take a look at the dollar index, an interesting pattern that it's had. It finally here. Let's look at the daily chart actually on the dollar index. The weekly charts haven't been so much, but you can see how we got light pink shading. We don't have a yellow line because we're not anywhere near the moving average. That's how bullish the dollar move was here. And now again, this doesn't have, the market doesn't price in. This is the market pricing in recession, and the market doesn't do a good job of pricing in recession because no one ever does a good job of pricing in recessions on a broad level. Gold, same thing. That's the market pricing in recession that we might never get to. And again, we saw that last year. If I were to go back to last year, the market was pricing in recession. We never got to it. And look at that move that came out. And now it's trying again. And again, you can see from a long-term level, the same bullish divergence we're getting on yields, which would be a bearish divergence on bonds. You're getting also a significant bearish divergence on gold too. You look at TLT for bond prices. Again, a significant bearish divergence developing, and we saw that before when the market was trying to price in that recession over here, a significant bearish divergence that led to a big sell-off in bonds. And you look at gold, and then there's that move right there to July of 2000. This was September 2012, and boom, all the way down to 15. So significant sell-off, and the market was trying to price in a double-dip recession there. So very well could be a possibility of that happening again here. In fact, in terms of like long-term bullishness, I can't think. I would be more worried if we were in this case, right? When we were when gold is really, really low or yields are really, really high. That's a lot more concerning to me. In terms of could we go into a recession? Are we being a little excessive with risk taking? That's a much bigger concern. Not when yields. I know when yields get really low, they make for this great, frenzied headlines. Yields hitting all-time lows. Now, that doesn't lead to, to a deleveraging, right? This doesn't. If there's anything is delevered, it's these big moves in the safety trade. And if those are delevered, what do people delever into? The risk trade. So I can't think of a better environment for a long-term bullish move to come out of than these tremendously bullish, I guess you could say a tremendously bearish divergence in the safety trade, where we're going up to significant highs with much lower lows, lower highs on this PPO, this momentum, long-term momentum indicator, with the market pricing in a recession that has a horrible track record of doing so, as of what we've seen in the past. You go back to the last recession, yields were up to 5.25%, because that's where the short-term yield was up to 5.25%. We're at 1.25%. It's a much, much different environment now than we were in then. Much more stimulative environment now, as you've already seen some with the housing sector, with mortgages refinances. And the ability for house prices, lower mortgage rates lift house prices, and it's a much different environment than when we're really struggling with high yields and high inflation and high commodity prices. That's usually what leads into recession, and we don't necessarily have that yet. Let's take a look at the 12 grid for the sectors. Dark pink shading all across the board, except for the safety trade down the bottom right corner, which is getting, which eventually probably will. You can see it's getting the light pink shading and the yellow line, but everything else is dark pink shading and red lines, and they're all right around the 30s. Energy is the worst. You know, it's at 10. The intermediate line's at 10. Everything else is in the 30s. I mean, this is very, very typical. When the markets go south, everything goes south. When the markets go up, then some things go up, some things don't. Some things get really bearish. I mean, there's a much lower correlations among these sectors when the markets go up. But when the markets go down, it's practically 100%. And another sign of a short-term low when they get as as correlated as they are right now with all these intermediate lines, pretty much all at the same levels here, and all dark pink shading and all red lines on the chart. All right, so for our trade idea of the day, stock that's kind of on the bearish run as much as anything else is FedEx. You can see FedEx is about to get, I had this kind of bullish, temporary bullish run. It's very bearish when you get these, and they don't go up. They don't get going on this 1 to 3 month run, and they turn right back into bearish moves. And you can see even without this coronavirus, it was that way already before, and it's working its way back down to a new bearish intermediate run again here. The difference is, look at the Bollinger Bands, or the volume profile for FedEx, is, we're hitting levels. If we get below here, it's to the downside, and it's got earnings coming up by March expiration. It's got a lot of pressure on, a lot of volume up above us. So there's an opportunity to be really speculative on here, because if, unlike other stocks that are way bullish and are heading towards support, this is not heading towards support. It's already broken a very significant support on this move, and there's very, very little support below where we're at right now. So it's got the opportunity of not just a 1 standard deviation, but 2 standard deviation moves to the downside, considering it's already made a pretty decent move. So I wouldn't bank on 2 from today, but it's already made a pretty decent move. And you look at the bearish trend. We had a bullish trend. You can see how noisy it's been. In fact, if you take a look at the weekly chart, we had a really strong bearish trend, a little bit of a descending triangle, an opportunity to really be bearish here, especially if there's any kind of mention about airline travel, this transportations, all these types of stocks are really struggling. If you take a look at this 3 green arrow chart, you can see that it's the MACD and stochastics are circulating their way down already, and got some room to go down, considering that we're already at the low point. If you look at its DMI chart for FedEx, the other significant thing here is the negative is easily above 25, it's all the way up above 30. The positive is below 10. The ADX is rising. So as bearish, as sideways as we've been with such a low ADX, we are above 20. So we are in trending. We are in a mode where we can trend, and we can trend and make a significant move. In this case, we made a significant move to the downside. We can do that, and we did it here. We started to move to the upside, and then it reversed quickly to the downside last in May. So that's the kind of, there's a big move coming out of a stock like this. In fact, if you take a look at, let's go back to those Bollinger Bands for FedEx here. They're pretty wide, relatively wide as it is right now. But you look at the 5-year chart, and they're actually relatively low. And again, look how significantly bearish we are. And even on the 5-year basis, very little volume below where we're at right now. So it's got significant moves. So if it goes up, we want something that will lose us a little bit of money, even if I can cut that in half, right? So if I can cut that in half to 100 and, whatever it would be, 100 and what? $50 plus 35, $185. If I can keep it to $185, but a maximum reward of $2,000 if we make a move to the downside, that's what we're doing. So I'm buying a 130 put, selling a 125 to help finance it. It keeps the cost really low. And then, like I said, I'm position sizing, because if that earnings and we take off to the upside, then the market bounces significantly to the upside, then I want to keep my losses really small, and it's going to be hard to keep it to half, because they can move up quickly and I can be down a lot. So I'm going to just cut my position really small. So it's even less than a half. This is like, if half a normal position is $500, I'm using 370 here. So that's how small my position is. So if I'm wrong, I lose a little bit of money. That's kind of a common theme here. When you're trading in a volatile market, you got to have strategies where if you're wrong, you lose a little bit of money. And if you're right, you make a lot of money. And that's what we have here. We're making a lot of money for the little bit of risk that we're taking, even in the worst case scenario. And the nice thing is, if I'm wrong temporarily, right, if we get a really short-term bounce, but then we move over and then we eventually roll over and break through lows, I've got the flexibility built into the trade that I can withstand being wrong in the short term, to let it continue to play out, especially with that earnings coming up right before the expiration, and that the earnings might be the fuel that's needed to break it down to the downside. So that's the beauty of that type of strategy. Again, that's you've heard from me now. Now I want to hear from you. Use that link right there in the top right corner of your screen. It takes you to our Market Outlook forums on Market Scholars. One of the things you get for free on our site. I showed you how to subscribe earlier. So post any questions you have for me in that Market Outlook forum, any comments you have about the video, and let's keep this conversation going among our Market Scholars community here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content between the videos, and join our community, our Market Scholars community, at our website as well as on our Facebook group that we have. Thanks everyone. Have a great rest of your evening, and we'll see you all next time.